Coal India stock has been going up sharply. A big reason? Its new green plan of buying lithium mines in Chile, Argentina, and Australia. I'll be honest with you. When I started researching this, I wanted to believe the story. A coal PSU pivoting into lithium for India's EV future. That's a great narrative. Bull case practically writes itself. But the more I dug into the data, the more uncomfortable I got. And by the end of the research, I'd completely changed my mind. If you own Coal India for the lithium rating story, the next 9 minutes are going to challenge how you're thinking about this stock. I'm going to walk you through four hard facts that the bull case has to contend with: capex, execution, timeline, and the lithium market itself. By the end, I think you'll see what I see. This isn't a transformation story, it's an optionality bet, and it's being priced like a sure thing. Quick context for anyone new here: Coal India is the world's largest coal producer. Roughly 80% of India's coal output comes from CIL. Over the last 2 years, they've made a lot of noise about diversification. They incorporated a holding company in Chile. They are in talks with Argentina and Australia. They've announced a 5-year capex plan of 1 lakh crore rupees. And the market has read all of this as a structural pivot away from coal. I'm going to argue today that the data tells a very different story. Four pillars: capex math, execution track record, realistic timeline, and the lithium market itself. Let's start with the money. Here's what most retail investors miss. When you hear 1 lakh crore over 5 years, it sounds enormous, and it is for coal. But almost none of it is actually going to lithium. Coal India's FY26 capex is 16,000 crore rupees. Of that, the solar capex, their renewable energy push, is about 961 crore. That's roughly 6% of the year's spending. The lithium specific spend, it isn't even broken out separately. It's bundled into critical minerals exploration, which, when you read the annual report carefully, is a fraction of even the diversification bucket. Here's the comparison I want you to sit with. In the same FY26 capex plan, Coal India has earmarked roughly 3,300 crore rupees for new coking coal washeries. Read that again. They are spending more than 3 times as much on washing coal as they are on the entire visible green diversification. This isn't a transformation. It's a coal company spending 95% of its capital on coal, with a small bet on the side. The market is pricing in a transformation. The capex is telling you something else. Here's the pillar I think the market is most wrong about: execution. The assumption baked into the bull case is that mining is mining. Coal India mines coal. Lithium is also mined. Therefore, Coal India can mine lithium. This is the cleanest example of dangerous reasoning I've seen in Indian markets this year. Let me show you why. Coal India tried to sign an MOU with Chile for lithium block acquisition. Chile rejected them. The reason: Coal India had no prior mineral mining experience. This wasn't a procedural issue, this wasn't paperwork. The country with around half the world's viable lithium reserves looked at Coal India and said, "You don't qualify." Coal India has never operated a mine outside India. Coal India has never produced a single kilogram of any non coal mineral commercially. Lithium extraction isn't coal mining. Brine extraction in South America is salt flat evaporation chemistry. Hard rock lithium is concentration and refining. Both require downstream processing: lithium carbonate or hydroxide, which is a completely separate technical capability. And there's a track record problem too. Coal India's previous attempts to acquire overseas coal assets, their own domain, never materialized. Multiple rounds of discussions, no closures. So we have a coal mining PSU with no non-coal mining experience, no overseas operating history, that just got rejected by the largest lithium reserve country for not qualifying. The market is pricing in successful execution. The data is pricing in something else entirely. Even if you set aside execution risk, the timeline reality is brutal. Let me walk you through what actually has to happen for Coal India to generate 1 rupee of lithium revenue. Step 1: acquire a producing or near producing block. They are in talks with Chile, Argentina, and Australia. None of those talks have resulted in a signed acquisition yet. Step 2: exploration and reserve confirmation. Globally, this takes 2 to 3 years for experienced operators. For a new operator in unfamiliar geology, longer. Step 3: feasibility studies, environmental clearances, mine development. For hard rock lithium, 3 to 5 years. For brine, 4 to 7 years. Step for production ramp and first commercial sale. Add another 1 to 2 years post completion. That's the global benchmark for experienced operators. Now layer on what I call the PSU execution premium. Indian PSU project timelines historically run 1.5 to 2 times private sector benchmarks. That's not a slur on PSUs, it's a documented pattern across decades. So, even in the optimistic case where Coal India signs a deal next month and executes at private sector speed, first lithium revenue probably lands somewhere between FY30 and FY33. Re-ratings on 5 to 7 year horizons rarely sustain. Markets re-rate on visible execution, not on announcements. Now the fourth pillar, and this one closes off the last bull case escape hatch. The argument I expect in the comments is even if execution is slow, the price is huge. Lithium demand is structural. So let me show you the price. Lithium carbonate prices peaked in late 2022. Since then, they're down roughly 80%. That's not a correction, that's a structural reset. Why? Because supply caught up. Albemarle, SQM, Pilbara, the Australian and Chilean majors, they all expanded aggressively into the 2022 price spike. That capacity is now coming online. And the most recent guidance from these producers is cautious. They're talking about oversupply through the back half of the decade. There are two more headwinds I want you to be aware of. First, recycling. By 2030, secondary lithium from battery recycling will be a meaningful share of supply. Lower the supply gap, lower the price ceiling. Second, chemistry shifts. LFP batteries are gaining share against NMC, particularly in entry-level EVs and stationary storage. LFP uses less lithium per kilowatt hour. Demand intensity is softening even as battery deployment grows. So here's the picture. Even in the optimistic case where Coal India produces lithium in 2031, they're walking into a market that's already worried about oversupply. That's not the price people are imagining when they buy Coal India for the lithium story. The bull case requires both successful execution and favorable prices, two independent variables, both currently trending against the thesis. Now I want to address the three counter arguments I expect in the comments because I think they're worth taking seriously. First, it's optionality, not core thesis. Even a small chance of success is worth a lot. Optionality has value, but optionality has to be priced. When the market pays full re-rating premium for an optionality bet, that's 5 to 7 years from first revenue. With execution risk and price risk, that's not optionality being correctly priced, that's optionality being treated like core earnings. Second, Coal India has the balance sheet and government backing. They'll get there eventually. Balance sheet doesn't compensate for execution capability. ONGC has a balance sheet too. They've been trying to acquire overseas oil assets for 2 decades with mixed results. Government backing in foreign jurisdictions is double edged. Chile already showed us exactly that. Third, even partial success would re rate the stock significantly. Possibly, but for that re rating to sustain, partial success has to be visible. Actual production, actual revenue, actual cash flow. Announcement driven ratings fade. Coal India has already had its announcement rally. The next leg requires execution, and execution is what the data says will be slowest. So here's where I land. Coal India's lithium story isn't a lie. It's just being told too loudly, too early, and at too high a price. The capex isn't transformative. The execution capability doesn't exist yet. The timeline puts first revenue 5 to 7 years out, and the lithium market they'll eventually enter looks structurally different from the one being priced in today. I started this research wanting to believe the bull case. The data didn't let me, and on this channel, I'd rather follow the data than the narrative. If you found this useful, subscribe. This is the kind of contrarian research I'm doing on Indian stocks every week. Tell me in the comments where you think I'm wrong. I read every comment, and if you have data that changes the picture, I want to see it.